The primary purpose of this podcast is to educate and inform. The views, information, or opinions expressed by hosts or guests are their own. Neither the show nor any of its content should be construed as investment advice or as a recommendation to buy or sell any particular security. Security-specific information shared on this podcast should not be relied upon as a basis for your own investment decisions. Be sure to do your own research. The podcast hosts and participants may have a position in the securities mentioned personally through sub-accounts and or through separate funds and may change their holdings at any time.
Welcome, everybody, to a new episode of This Week in Intelligent Investing. Great to have you with us, and great to welcome my co-host, Elliot Turner, as well as our returning special guest, Bill Chen of Rhizome Partners. This will be part 3 in a series on public equity investing in real estate. Really looking forward to another great conversation. Elliot, over to you.
Great. Thanks, John. And we have, as John said, Bill back on the podcast. I think it's super timely. He's coming back from REIT just last week, and John had an awesome week at the Zurich project. So, happy to have both of you with me off of these exciting events. And I'm really interested to explore some further depth in the real estate space with Bill. We've got some great topics lined up, and I think Bill has something fun to kick us off with. So let's turn to you, Bill.
Okay, so I'm going to start the podcast today with a quiz, and this quiz involves Vornado Realty Trust, which is a company that was talked about in a CRE episode last year. And so the quiz is: Jeff Sutton and SL Green sold the retail portion of 715 to 717 Fifth Avenue to Kieran, the French luxury group that owns Gucci, Balenciaga, and Alexander McQueen. This is a retail space that totals 115,000 square foot, and New York Life in 2022 tried to foreclose on this property. How much was this transaction sold for in millions of dollars and also dollars per square foot? I will give a multiple choice test. All right. This is so this property is on the corner of 56th Street and Fifth Avenue. It's multi-level. So this is not just a ground floor level retail. And the choices are A, $115 million, which is around $1,000 a square foot. B, $300 million, which is around $2,609 a square foot. C, $500 million, which is around $4,347 a square foot. Or D, $1 billion, which is around $8,695 per square foot. So the objective is to pick the choice that is the closest to the actual transaction value.
Okay. Let's see. First off, this Vornado podcast was the one we'd done with Phil last year, maybe around this time. So I'm going to, with that preface out of the way, I'm going to guess C. And I'm just thinking, it can't be the highest number, but it's got to be something better than we'd all think, given the skepticism that we all expressed about CRE back then. So C is my guess.
So I'm gonna just, I was also thinking C, but I'm gonna go with D just to have another opinion here.
Okay, well, John, you win. The actual answer.
I had a feeling that was the case. It's like, I can't go with the biggest number, but yeah, that makes sense.
So the actual answer is $963 million, which is about $8,374 a square foot.
Wow. So, presumably they're saving, they were former renters and they're now owners. So they're saving their rental expense. And is there something strategic behind it? Are there like developmental rights with it? Or they wouldn't even want to do that, huh?
No, they definitely would not want to do that. And I believe this space may just be the retail portion. So one thing that's very unique about Fifth Avenue retail, which is, I believe, officially the most expensive retail quarter in the entire world. In every major city worldwide, there are, in Chicago, there's Michigan Avenue. In Boston, I forgot what that street is, but there's one in Paris. Like in every major city in the entire world, there's always one retail street where the absolute best and most prestigious retailer, they all set up flagship shops there. And it is so a lot of these luxury brands like LVMH, like Gucci, the Kering Group, and even lower value brands like a Uniqlo, they made a conscious choice that they want to be on Fifth Avenue and they want to establish a flagship. So this is the absolute definition of in real estate when we say location, location, location. Fifth Avenue retail is a whole different beast on its own. And so here's some other interesting notes.
Can I ask you one question about this property before that? Do you know what Vornado is holding this on their balance sheet at?
So this is a great question. Vornado, well, let me give you another quiz. Vornado owns a portfolio of retail assets in, let me look at the stats. In 2019, in 2019, okay. So in 2019, Vornado sold about half of their Fifth Avenue and Times Square retail portfolio. What do you think that valuation was?
Wait, so say it again. Half of their retail.
Yeah. So Vornado owns a
Times
portfolio.
Square?
Yeah. So
how many buildings? Yeah.
I think it's.
Give me more information, and I'll try.
Give you more information. I believe the total square footage is between 500,000 to 1 million square foot.
I see. So I'm going to say $1.5 billion.
Okay. Well, I mean, Elliot, we just had a comp here that for 115,000 square foot, that was sold for about $1 billion, right? So
Yep.
this is somewhere between 500,000 to 1 million square foot. I don't remember the exact number. It is bigger than it was a multi retail location portfolio. So it's about 4 or 5 times the size of this recent transaction.
But it shouldn't scale proportionally, right? Because you said, we're going from location to something that's really good, but not the best.
Well, no, that portfolio was specifically, they were all either on Fifth Avenue or in Times Square.
Oh, I see. All Fifth Avenue. Got it. Okay.
Yeah,
so do you just 4x the price of that, basically?
Roughly. So ready for this? That deal was done at $5.56 billion.
In each of these deals, did they have like debt secured at the property level that was fixed during the ZIRP period? And so were they getting some value for like long duration, cheap debt?
There's roughly $800 million of debt, if I remember correctly, against. So it was a deal that was done at $5.56 billion valuation, but the in essence was done at like a 4% cap rate. And
Wow.
and the amount of debt. So if you think about $800 million of total debt against $5.56 billion, it's very minimally levered.
That's interesting. Why do you think people are willing to transact in these kinds of properties at a 4 cap when treasuries are, obviously higher than that?
Well, let me give you a little bit of history, okay? So, Fifth Avenue retail on there's a stretch between, I believe it starts in, again, going back to what I said about location. Fifth Avenue between 42nd Street to 49th Street is a certain rent price. Fifth Avenue between 49th Street to 59th Street, where on the northern side is that GM building with the Apple store. I'm sure you guys know that one.
Yeah.
Right? that's a different beast. That's a stretch where rent at one point was as high as $4,000 a square foot. And the trajectory of that rent growth was roughly, when I worked at 666 Fifth Avenue, which is on Fifth Avenue and 53rd Street. It was that's when Uniqlo signed one of the biggest lease at the time, rumored to be the most expensive at the time on a per square foot basis. And everyone thought that that was a crazy number. I think that was roughly around $1,000 a square foot in rent. It subsequently went to about $4,000 a square foot, and it has come back down to about 2,500 square foot. There's a organization, REBMY, Repni. I don't know how you pronounce it, but they published an incredible retail report that tracks all the long-term rent trends in all the major retail quarter in Manhattan, and it's just incredible. So like, again, this goes back to a question of, why would anyone now keep in mind 2019 when they did this deal with the and this is like a Middle Eastern sovereign fund that bought half of this property. Vornado still retains half of this retail portfolio. They got $1.2 billion in cash, and they received the remaining amount in preferred stock, which they still own those preferred stock. So Vornado's interest in this retail portfolio is over $1 billion preferred stock and 50% common equity interest, with only roughly $800 million of debt against this portfolio. So going back to your question, right? I know this is like a very long, winded way. The simple answer is rent growth on that retail quarter has simply been astonishing, right? To go from $1,000 a square foot to $4,000, like in less than a decade. Now, of course, nothing goes up forever. At some point, there was a correction. And I think, the rise of e-commerce and Amazon have taken some of that shine off, right? Like, where there could have been a retail concept that was mostly mainly in the sale of goods, and not on the luxury side. Like, it kind of didn't make sense to kind of pay that kind of astronomical rent on Fifth Avenue. But I think the luxury brands, by their action of Prada buying back their building, Kering buying back their building, I think it's sending a statement that this is a long-term strategy for them. This is, and in their computation model, they're thinking in the long run, rent on Fifth Avenue will probably continue to go up, and they rather buy those buildings because if they want to stay there, if they view Fifth Avenue as a strategic location that they're going to have a flagship store on in the next 10, 20, 30 years, then they want to own those buildings.
So if they, in Vornado, right, they have a lot of this retail space. They also have a lot of this office space across New York City. Are they just partially trying to highlight the fact that they think the market's undervaluing them, that their book value is not a clean proxy for what they're worth? And, they're illustrating that with, I guess, some of their most prestigious real estate assets. Like, what's the point here? Are they going to then use the cash to repurchase shares? Where does it play forward for them?
Sure. Well, so I think Vornado trying to explain to shareholders that they're undervalued has been kind of the world's tiniest violin for the past, call it 7-8 years, right? Like, it's a perpetual, we're cheap. How do you close the gap? Now, there's a big difference between how Stephen Roth, views share buybacks versus the teams at SL Green. The SL Green team have actually bought back shares at much higher share prices than today, and that actually led to the balance sheet being less than ideal over time. And they, in hindsight, they bought back shares at much higher prices than what they're currently trading at. Vornado has resisted share buybacks, although around sometime last year, they actually thought that share buyback, they came out for the first time and thought that share buyback was actually a potentially good use of capital. So what's, my main purpose of bringing this up, the retail portion up, is to illustrate that Vornado is a very interesting beast in that Vornado is not just a pure play office REIT. It really, there's actually a good chunk of value in their, what is called high street retail portfolio. And I will try to explain why we bought the prefers in Vornado last year. That's what the quiz is trying to get at, is that, like, where are these hidden value in Vornado, and why did we buy the Vornado prefers? What kind of analysis? And the analysis that I'll walk through is a framework to kind of think about, like, what's the proper way to look at a REIT, because the main goal that I want to explain is, when you look at a REIT, looking at the consolidated debt, looking at the total debt and dividing it by the EBITDA, that's a very, very important metric that you should be looking at. But that is not, like, the analysis shouldn't end there. The right way to look at a REIT is, I'm sure both of you know about that distressed debt analysis book by Stephen G. Moyer, like the one with the chess pieces on the front cover.
Not super familiar, no.
Okay,
I've seen it.
You've seen it, okay.
That's about as far as I got. The chess pieces.
Okay, it pops up on social media, on Twitter, in the very nerdy world of FinTwit, and I read that book during the GFC because I really want to learn how to do distress investing at the time, and it is very applicable to REIT analysis, and the way that we should think about analyzing Vornado is that REITs are interesting beasts in that sometimes your unsecured debt, your preferred, and your common could, in theory, be more senior to the secured debt. Because when we talk about a secured debt for a REIT, oftentimes what we mean by that is that there's a mortgage on one specific property. And what that does is that it gives you the optionality where, if that specific property, it has no equity left, right? It's functional obsolete. It's got very little cash flow, and you can't service the debt. And it's on, First Avenue instead of on Fifth Avenue. It's just not competitive anymore. And the building is worth less than the debt on it. You could strategically default on that. Now, there's some nuances where sometimes the parent could guarantee the debt on it. And we looked at the disclosures. I believe there's like one or two properties that Vornado have guaranteed the mortgage. But for the most part, they are non-recourse secured debt or non-recourse mortgages, which means that the right way to think about it is that the capital structure of Vornado is really, the most senior would be, the most senior at the corporate level is the unsecured debt. Then it's the preferred. Then it's a common, right? And then you have, like, all these, like, think about grain silos, right? There's like all these grain silos, and some of it are good. Some of it has a lot of equity in them, and some of it has, no equity in them. And they're all silos. They're all independent from each other. So the ones that are impaired and just have no prospect of earning good return, no equity left in them, you could kind of just, like, knock them down and hand the keys back to the bank. So that is precisely the reason why around 12, 15 months ago, awesome Vornado common shares dropped by half. And the prefers traded to about 45 cents on the dollar. So this is a $25 par prefer. And it traded to $11.71. That's when we started doing some of this analysis. And we bought some at that price. It was yielding 11.5%. And so the cap structure, the way that we look at it is when you look at the Vornado cap structure, there's let me pull this up real quick. The Vornado cap structure has, as of end of March this year, is $10.3 billion of debt. This includes consolidated debt. This includes debt at non-consolidated entity. Usually means that they own less than 50% of it. So there's a total of $10.3 billion of debt. Now, keep in mind, there's the debt that is unsecured. There's $1.2 billion of unsecured notes, senior unsecured notes. There's $800 million of unsecured term loan, and then there's an unsecured revolving credit facility of $575. So those are what's ahead of the preferred. Now, mortgage, there's $5.7 billion of mortgage debt. Now, remember the silos, right? There are multiple properties in that bucket, and there's you can kind of think of those are optionality, right, to the preferred. So at the time when we bought those prefers, what's fascinating is that we knew there was about at the time we bought it, there was on the liquidation analysis 2.57, call it $2.6 billion of unsecured debt ahead of preferred. The preferred as a class had a face value of $1.2 billion. But because they were trading at such a low price, at like 45% of par at the time when we bought it, we basically created the preferred at something like a 14% cap rate, right? That's what made the Vornado preferred so compelling about a year ago. And then so you buy something at a 14% cap rate, but like you also have the optionality from all the non-recourse mortgages, all the equity in some of those non-recourse mortgages, right? So what are they, right? Like what are some of those non-recourse mortgages, right? So Vornado owns a building, 350 Park Avenue, which is, has a $400 million debt on it, doesn't generate that much, NOI. But that is going to be the site of Citadel's headquarters. That's going to be built and delivered in 2032. Now, Vornado actually owns a put where they could put that building to Ken Griffin's Citadel at a $900 million valuation. So you look at this building and you say, oh, it's old, it's dated. Like people may not want to lease that property anywhere going forward. This is maybe 3 or 4 streets from JP Morgan's headquarters. And that was a really important part of our underwriting, right? Because like we were able to just on that one property, essentially realize that there's a $500 million of equity value that could be used towards the unsecured debt holder and the preferred holder, right? So that was just one instance where they literally have a put option. If things get really bad, they could put that building to Citadel at a $900 million valuation. There's another building called 1 Park Avenue. It has at the time, the NYU Langone signed a 27-year lease in 2020, I believe. So as of today, there's 23 years left on that building. Now, like on a long enough timeline, when an office building has over 20 years of lease on it from someone like an NYU Langone, that's not really a piece of real estate anymore. That's really, you kind of own a bond in NYU Langone at that point, right? So that was like another property that stood out. Now, there's more, right? There's we're finding all these like pockets of value. We're finding value in the retail. We're finding value in this put option to Citadel's headquarters. The 1 Park Avenue has a really long-term lease on it. And then some of the other assets that they own was also interesting because the Farley building, how familiar are both of you with regard to like the different buildings surrounding the Penn area?
Just a little bit from having looked at Vornado, but otherwise not very much. Obviously, Madison Square Garden is over there.
Yep.
Yeah, I'm fairly familiar. Taken
Okay.
Long Island Railroad to Penn Station a number of times. Spent a lot of time around that area.
Yes, and yeah, probably some games there as well, Elliot.
Some games, a lot of fish concerts. Been
Yeah.
around the Garden a decent amount.
Okay.
As an Islanders fan, I view it somewhat as hostile territory, though. I'll leave that out there.
Yes. Well, so what's really interesting is if you look at the supplementals. One way of looking at the valuation is that now forget about the silo. Let's revert back to consolidated. Let's look at the consolidated. The company is telling you that they do about $1,080,000,000, $1.08 billion in net operating income. That's what the current run rate is. But if you pay careful attention to their supplementals, and this is why I love REIT investing, right? Because the company just gives you so much detail. And specifically for a REIT like this, they give you building level detail, right? So there's the I'm looking at the map. There's Penn 1, which is the building. So if you look at Madison Square Garden, Penn 1 is the office building to the north of Madison Square Garden, right? And Penn 2 is the building that is to the east of Madison Square Garden. And then you have Farley, which is essentially an entire city block to the west of Madison Square Garden, which Meta has signed a very long-term lease, I believe 10 or 12 years, right? So again, like as you start to dig deeper, all this narrative around office is very, very negative, okay? But then you kind of like take a step back and you say, okay, like who are your tenants? Your tenant is NYU Langone, who signed a 27-year lease. Meta, who signed a 10 or 12-year lease. I don't remember the exact detail. And then they also invested a good chunk of capital into Penn 1, the building to the north of Madison Square Garden, and that is close to that is in essence fully leased. Okay. And then there's a building, to the east of it. And that's where, like, if you're going to the Long Island Railroad, you're coming from 6th Avenue. That's the building that you saw. And that's a building, before Madison Square Garden, before you go down the escalators, right? So that is mostly that building. Penn 2 is largely empty at the time right now, but it's largely empty because it just underwent this massive, like $750 million transformation, which is almost entirely paid for, and they expect to. I think. Let me look at my notes here. So Penn 2 has 1.5 million square foot of office, and it could probably charge about $100 per square foot in rent. So that could actually generate $150 million of additional revenue. Now, if the question is, well, would anyone actually want to lease Penn 2? There's like, depending on who you ask, right? There's a lot of New Yorkers who absolutely hate the Penn district because it's just busy. It's where all the train comes in. Sometimes, there's different, like, kind of unsavory characters who hang out in the Penn Station, just in the concourse area. But in a world where people only go into the office 2 to 4 days a week, like, do you want your office to be located like where the Long Island Railroad comes in? It's the last stop on the Long Island Railroad, and then you literally have, like, if you start counting, you got the ACE, the blue line that stops there. You got the orange line, which is a BDFM, right? BDFM. And then you got the 2-3. You got a 1-2-3, the red line, 1-2-3. They all
and the
stop
NRW's right there too.
Okay, are they? Okay.
They're on
So
6th Ave, but same thing.
Yep. So literally, what is that? Is that 12 subway stops plus the last stop on the Long Island Railroad.
And you have the 7.
Mm-hmm.
Oh,
The
wait, no.
seven's on the seven's on
Yeah,
42nd
that's right.
Street. Yep.
That's right.
So
Yep.
like if you look at the future of office, Hudson Yards has been getting a ton of buzz. But the only way to get there, I believe, is on a 7 train. It's very difficult to get to. Versus you literally have what we just counted, like something like a dozen subway lines that stop there and the last stop on the Long Island Railroad. From a transit perspective, I think in the future, when people want to come in for two to
And
4
Jersey
days
Transit,
a week.
by the way, also.
Yes. I forgot about that. How could I forget
I always
about
forget
that?
about Jersey. You're fair for
Yeah.
forgetting that.
Yeah. And does the PATH train go there as well?
Yep.
I think the PATH
So it's
train
a hot
goes.
area. Definitely makes sense to me.
Yes. So I would say that the odds of the Penn District being a place where people because now when people come in, they don't want to get into Penn Station and then make a trek over to somewhere else. They just want to get into Penn Station, go into the office, and then go home, right? So from a transit perspective, I would say that Penn District actually looks a lot nicer today. So I think that Vornado is in a much stronger position than people may think it is on the surface because of all this dynamic. So if we start with that $1.08 billion of net operating income and add in if you lease up that Penn 2 building to call it like 90% occupancy, there's probably another $100 million net operating income in that building. And then there's some retail at Penn 1 where I think that could also add 227,000 square foot of retail. There's probably $35 million of net operating income in that portfolio. And then, so Elliot, this is where Fifth Avenue is so different, right? So Penn 2, which is mostly on call it like 7th Avenue and 33rd and 34th Street, right? I think that's $150. Let me just check the the supplemental here. That's not $2,000 a square foot in rent. That's in that between $100 and $200 a square foot. And this is why location is so different, so important when analyzing real estate. So if you take Vornado and with all this doom and gloom, and you start at $1 billion and $1.08 billion NOI, and that could realistically bring it to $1.2 billion of NOI. But I'm aware that over time, some of the weaker assets, particularly the assets on 3rd Avenue, on 7th Avenue, some of them they may have to give some of those keys back to the bank, right? There's just there are weaker assets in their portfolio. I wish Phil was here because they own a building called the Mart in Chicago. I just really don't have a strong opinion on that property. I don't know why. It's a gorgeous building. I've seen it from the outside, but I don't really know what's inside. I don't really understand why people are there. But based on their assets on just on the few assets that I listed, the Farley building, the Fifth Avenue retail, the Penn 1, Penn 2, the put option they have, to Citadel, the long NYU Langone leases, that I think just based on everything, and then the optionality on the other buildings, I think that covers the full liquidation value of the preferred, which would kind of bring it to about call it like $3.9 billion. I think that's very well covered. And we were buying the preferreds at 45 cents on the dollar.
So a couple follow-up questions on a few of these points. I guess, first off, you talked about the optionality on giving away the keys to a property that's now worth less than their debt, right?
Mm-hmm.
I think if you go back to that podcast episode we'd had on CRE, one of the bigger questions becomes if there are call it meaningful, I don't know if that's the right word, but a meaningful number of properties that are now worth less than the debt that secures them, or that they're secured by. Don't you start having a problem where someone in the system is going to be realizing significant losses, and then who ends up like cleaning up the balance sheets of wherever those properties reside? And how do you end up in a situation where there are potentially fire sales and protect the value of what's left at someone who owns a lot of equivalent and comparable properties?
So that's a great question, Elliot. And this is something that, one of the reasons why I'm so active on social media, on Twitter anonymously, is because I'm paying a lot of attention. There's a lot of speculation on who owns those debt, who's got the most exposure. And so a couple things you want to think about is, if when they don't give the keys back, what is the residual value? How much loss are we talking about? Let me give you guys another quiz, right? What do you think if you had a totally vacant office building in New York City? How much do you think that vacant office building is worth on a dollar per square foot basis?
Where is it?
Great question. Great question. Okay.
Hey, you told me location, but yeah, where is it?
Yes. That's Elliot. That's a great question. Well, so okay, let's say it is like a generic location, like 7th Avenue or Lexington. It's not on Park, right? Because I think Park's got strategic value as redevelopment potential. It's not on 5th Avenue, so it doesn't have that retail. But just kind of think like a generic location that is not in a unique hub like a Grand Central or Penn Station. Like it's got no special location value.
But it's a Class A.
No, I mean, I would say let's call it like a functional obsolete. It needs to be like repurposed. It needs to be repurposed. It needs to be repurposed. It's got very low occupancy. Let's call it below 50% occupancy. Like some guesses on like what that value will be.
And you just want the straight up kind of selling price for the building, including the debt. So kind of
it'll be like at the asset level. So like we're not talking about leverage. We're just thinking like dollar per square foot.
$500. Sorry.
Yeah, that's exactly what I was gonna say.
Okay. So the answer is somewhat so that's optimistic. That would be very optimistic. So if you own a building in kind of like a generic location in New York City that isn't 5th Avenue or Times Square, it doesn't have like these like really unique location characteristics. And then the second part is actually floor plates. And this is a topic that I've been meaning to kind of talk about, is that why is office conversion so hard, right? There are buildings in New York City that are probably squares, these gigantic squares that are, call it like 200 feet by 200 feet. The problem you run into is that if you want to convert that into residential, it's too deep. Right? Like maybe you could use up to 30, 40 feet. Like 40 feet is absolute max that you could go. I would probably say like 30 feet is probably the most you could go. So that leaves on a 200 feet, square. You're leaving something like 140 feet of like you're leaving like 140 feet square in the middle. Like this is like that Munger building. Remember Munger try to get that the permits for that building in California where it doesn't have, there are certain internal units that doesn't have like, the dorm room, right? This is the problem that that developers and architects are running into, is that you got this gigantic floor plate and really only the exterior with access to light could be converted to residential. So the answer to your question, to answer to that quiz, what we're seeing is if you got a building that is actually suited for residential conversion, it is, we've seen transactions around $300 a square foot. But if it's not suitable for residential conversion, it's probably worth less than $300 a square foot. So having gone through this exercise, what it does is that it establishes that the banks who own this, who provided the debt, the value is not a total zero, right? Because at the end of the day, you own an office building in New York City. There is some sort of land and location value just by being in Manhattan, just by being in New York City. So I think when you think about the hidden risk, the hidden time bomb in banks' balance sheets or the lender's balance sheet, it is very important to consider, okay, is this an office that is kind of got small floor plates? In a perfect world, this will probably be a rectangular shape with like, kind of skinny and rectangular, so you can make a lot of units with a lot of window area. That would be, like that is not the ideal layout for an office, but that's a very ideal layout for a residential conversion. And ideally, that building has, outside exposure on all four sides, right? Like the worst offices are kind of like a typical WeWork conversion where it's an older building. It kind of only have windows on one side, and then the back and the two other sides are kind of like adjacent to other buildings, and you're not getting. I've been in a couple of WeWork, locations that has those kind of characteristics, and the lenders will likely take the biggest loss on some of those buildings. But I think that one way to think about it is that there's probably somewhere between $100 to $300 per square foot of value, depending on the building configuration, the size of it, the floor plate, and how much of that can you convert into residential. So it's not, the lenders are not going to get a total zero on some of those buildings. I think the impairment is going to be meaningful and significant, but it's not a total zero because there are value. And this is also like a very unique New York City dynamic. Once you get out of New York City, what we're seeing is a lot of these offices, they're being bought to be redeveloped. It's sold more on $1 per acre because they're going to knock the building down and redevelop it relative to the floor area, to the ground area of the build of that entire office complex, right? So the developers care more about the how many acres and how much mixed use you could put on that site. So where are the debt hidden? When's it going to come due? I don't think anyone has any, Blackstone's given back a couple buildings. Brookfield's given back the downtown LA building in Los Angeles. It helps if these maturities happen on a staggered basis, right? Because then like the banks can kind of absorb that loss. And then they have other assets that are performing, that are earning a nice interest margin, and they can kind of, as they absorb those impairments, there's earnings to more than offset that, right? So I think it's important to kind of look at the lease maturity of the portfolio when they mature. Do the tenants leave? And like as an aggregate, I don't think we're not in the weeds necessarily. Like we're not so much on the I don't know the banks as well as I know specific REITs. And this is one of the reasons why I don't own banks myself, right? Because I'm always looking at it from a REIT perspective. And I'm always thinking, okay, well, can I strategically default on this property and give it back to the bank? And if I own a bank stock, I'm always thinking, okay, where are the like this is a black box, and where is that exposure where an office REIT could just kick one of those assets back to the bank and then all of a sudden I have an impairment. So I'm a lot more, my abilities are a lot better at analyzing individual REITs and understanding understanding their liquidity profile, understanding the solvency profile rather than on the banking side.
That all makes sense. And then I guess maybe it's kind of related to that side of things, but who is the incremental buyer for these buildings? Both in terms of maybe like trying to understand the potential of the market to clear, but are there any players who are public REITs who might be in position to take advantage of what could be some fire sales over the next few years? And I'm asking this question partly because one of the things I've known about New York real estate over the last few decades is like SL Green and Vornado were like scooping up one property after another, consolidating out some of the smaller REITs, and it seems like they'd be on the other side of the ledger nowadays. So, how do you think about that side of the coin?
So we have not really seen office has kind of become this like toxic asset class. We have not seen any real deals. I believe there was might have been like a Korean institution that bought some of SL Green's. It wasn't the entire building. Was like they made a partial investment in one of the buildings, which kind of created some buzz, around the office REIT sector. This is all within the last year. We have not really seen any sort of investment activity by institutions in the office space recently. We have seen there's a company called, the ticker is NL. It's the net lease portfolio. It's NLOP. We've been surprised by some of the asset sales how quickly they've been able to unwind that portfolio. So I've been surprised by that a little bit. Going back to your original question of, is it SL Green? Is it Vornado? I think Vornado's probably got the cleanest balance sheet, despite all the complexity that I walked through. But I think like like within New York City, I think Vornado's got the best balance sheet relative to SL Green, relative to Empire State, relative to Paramount. But I think Vornado's in their objective to lease up Penn 1, to lease up the retail at Penn 2, and then to, moving forward, the Citadel build out. So I think not in 24, but maybe in 25, 26, like Vornado may potentially go on the offensive and acquire some assets. That is my guess. Like if there's one public REIT to do it, that will probably be it. Now Blackstone Blackstone has made a very conscious decision to not have office exposure. That, in hindsight, Blackstone and Brookfield has been kind of Jekyll and Hyde in the sense that post GFC, Brookfield has gone into indoor malls. They have a lot more office exposure. And to Blackstone's credit, they correctly identified that warehouses, the rise of e-commerce, warehouses and industrial assets are going to benefit massively from these large secular trends. and they built they built a massive warehouse portfolio. Blackstone has not I don't think I've really seen Blackstone do an office acquisition in recent times, but Brookfield could very likely be a distressed buyer.
That's interesting. That makes a lot of sense. And then on that Vornado put option with Citadel, right?
Yeah.
Why wouldn't they just put that to Citadel right now, take the cash, and be like, okay, we're ready to go shopping when the time comes?
Um, I think that rightfully or wrongfully, I think that if you're sometimes like to a hammer, everything look like a nail. And if you're Stephen Roth and you're Vornado, you're in the office business, right? You're in the office business, and so what makes that development really interesting is that Citadel has committed to more than half of the available space as an anchor investor. So when you think about a massive development like that, and to also have a client like Citadel, which whether you love them or hate them, is probably one of the best credits out there. And to have kind of like a trophy anchor name like that, uh, you know, again, this goes back to at the end of the day, with a long enough lease term and a good enough blue chip tenant, every office building is really a bond, some sort of debt instrument on the tenant, right? Like once you go over 15 years, it's not really a piece of real estate. It's a piece of you essentially own bonds on the tenant. So I think that's why they're moving forward with that. And then you also own a brand new kind of trophy office building. And I do think that another thing to kind of think about is that the investing public may not like this right now, and again, this has to do with capital cycle theory. It takes a really long time in real estate. It takes a really long time for capital cycle theory to kind of play out, right? It's not like I invested in aluminum can packaging company in the past couple of years, and there was some oversupply, and it kind of took it took less than 2 years for the market for all the major suppliers to kind of pull back, get rid of some of their older supplies, production lines, and get the market back into more balance from a supply demand perspective. But when you have something as structural as the kind of work from home trend, the millennials aging out to the suburbs, a lot of these CBD, central business district offices, the supply dynamic could take a decade to work out, right? And depending on who you talk to, some of this trend started in 2017, but some of this, it really kind of accelerated post COVID in 2020. So if you start counting, 2020 is a year when kind of it really accelerated, demand kind of fell off. It could take 7-10 years for the entire kind of supply demand to rationalize. But I think there's even a little bit more dynamic with New York City, challenges with New York City in that it's one thing to go to the suburbs and knock down a two-story office building on a large acre. There's no neighbors, right? Demolishing some of these office buildings in New York City could be very risky and lead to kind of introduce a risk of potentially damaging the neighboring buildings, and it creates just like additional challenges, and this is especially true for buildings that are adjacent, mid block, that are adjacent on both sides to other buildings. So I think it's harder to remove office supply in New York City, and then you have the unique challenges where the floor plates are too big and it can't be repurposed as residential conversions. There's other challenges, like if you ever walk into a office to resi conversion project, it just looks the layout just kind of looks funky, right? Like it's not optimized When we kind of talk about that $300 a square foot, in reality, you are paying $500 a square foot on like a net effective basis, because if I'm building multifamily, if I'm building residential building from the ground up, I'm going to lay it out as efficiently as possible. The bedrooms are going to have certain orientation, certain square footage. The bathrooms are, they're laid out like in these like really nice, efficient ways. Versus when you take an office and convert it to residential, sometimes you get a really large walk-in closet. Sometimes the bedrooms are a little bit too small, and it has to do with like you got to work with the existing configuration. So there's the capital cycles could be very, very long in New York City office.
Got it. Well, that makes a lot of sense. I maybe want to change gears and spend a couple minutes talking about your experience at NAREIT, and would love to hear about, I guess, general sentiment, what the mood was like, and what some of the hot topics were in the space.
Sure. I mean, so I think that there wasn't the key. One of the biggest key takeaway was it didn't feel distress. Yes, the stock prices are down across the board, but there's no one really, no management team really seemed stressed. There was one management team who was the target of an activist campaign. So obviously, like they're trying to convince shareholders that they should, they should stick with their current incumbent management team. But for the most part, a lot of these REITs have very clean balance sheets. They have very good coverage ratios. They can cover the fixed cost payments, quite, quite a bit. And to put some numbers to that coverage ratio, a private deal, when you first underwrite it on the multifamily side, may have 1.25x coverage ratio. Most of the public REITs we were talking to are covering it at least 3 times. And in some cases, it's as high as 8 times. Like a company like Prologis could cover, I believe they could cover the interest expense by more than 8 times, if I remember correctly. So again, like Buffett said, you don't need to be precise. You just need to be in the general neighborhood, right? The right neighborhood. When the right neighborhood, that there's not any, despite all this doom and gloom about all these private real estates, people in Texas and Sunbelt getting into these private deals and potentially losing all their equity. None of the public REITs were really in those type of dire situations at NAREIT. They have great coverage on the interest expense. They have well-laddered debt maturities because a lot of these REITs learn from the GFC experience. What they've done very well, and I want to pull out a chart on Twitter. Someone, let me pull this out.
And we'll share
Because
this in the show notes, linking behind the tweet. So
yeah,
just for all you listening and not seeing.
mm-hmm. Like there's this great chart that someone posted on Twitter where from 2003 the EBITDA to interest expense for I guess like 6 multifamily REITs here has risen from 2.6 times. So this is how many times it's covering the interest expense, from 2.6 times to 6.8 times. So you use a Buffett analogy of margin of safety in a truck driving over a bridge, and the bridge is designed to take X many pounds of weight, right? It used to be that margin of safety was, factor safety was 2.6. Now that's 6.8. And then there's another metric where the net debt to EBITDA for those same six companies, was at one point up to 9.2 times at 2009, and that's come all the way down to 4.6 times. There's been massive deleveraging with the public REITs. And if you look at some of there were a lot of bankers at NAREIT, and every time that we talked to a REIT management team, they were able to tell us kind of if they went out and issued the debt, what that figure, what it would cost them. And they're mostly in the we heard things from high fours, although, call it like low, more like low fives to mid six is the cost of 10-year fixed rate debt that is unsecured, is generally like what we've been getting, the feedback that we got. There's a lot of REITs were talking about share buybacks. There's clearly access to capital. I would say that, they're more worried. Some of the smaller REITs that we met with were more worried about not being big enough, and they need to like grow scale because there are certain fixed costs of being public. And if you're a tiny, call it like a sub $2 billion enterprise value REIT, there's not enough net operating income to go around to pay for your, general and admin expenses of being a public traded company with audits, with, a public board, with a, executive management team, et cetera, et cetera. So, there are a lot of small REITs that we met with, we're generally kind of, worried about scaling up. On the multifamily front, which is where we had the most meeting, I think there was a lot of detail given on the absorption. And the general key takeaway is that, particularly in the Sun Belt, there's been this like fear that we're delivering the most amount of supply into the market in history, although not the most amount on a per capita basis. There's difference because population has grown since the last time we built this much housing, and the key takeaway there is that the absorption data has been way better than any of the REITs or any of the private, anyone has anticipated. And that's usually that's mostly due to the fact that people just can't afford single family homes with high mortgage rates and the high home prices, so they're stuck renting. Some of them suggested that some of the migrants that cross over, that's kind of like a phantom supply. Absorption stats are quite good. I mean, there's like a little bit more nuance in terms of like in some of those markets, you don't actually deliver an entire vacant building and there's all 100% of the units that are available. In a lot of markets, the building department will allow you to kind of, get COs on a floor level. So not all that inventory will be delivered all at the same time. Like there's literally be like, 1 out of 10 floors will be available for a lease. So you only bring in like 10% of supply. And psychologically that has like effects on the developer because they don't need to lease 100% of the unit at a time, right? So the key takeaway on the multifamily front is that what people will worry about on the supply side has played out. Demand has far exceeded what people's concerns were.
Terrific. To be continued. We are running out of time for this episode, Bill, but let's continue it next time if you're willing. I do have some questions as well that we will get to. This has been so terrific, and I think it's great for anyone interested in Vornado, but also just a great primer on how to actually value REITs and look kind of across the balance sheet and across those silos, as you mentioned, Bill. So thank you for that. Thank you, Elliot, for the terrific questions. And thank you all for listening. We will be back very soon. Take care for now.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.